We're live. We'll give people like 1 or 2 minutes to trickle in, and then we can get the party started.
Excellent.
I love Avalara's color scheme. The orange is so bright.
It stands out for
It
sure.
does. Especially your merch. Like, orange is the best color.
Not typically in my color wheel, but we make it work, you know?
Yeah. Hey, you can make it work anytime as long as
Right.
you wear it with confidence.
Exactly. Got to lean into it.
hmm All right, we can get started. Whoever comes in and joins us, joins us. But hello, Doug community. Hi, Shelby. Thank you for joining us and anyone else who may be watching this. Today, we have our team up partner, Avalara, joining us for a partner showcase webinar. They'll be presenting Managing Tax-Exempt Sales 201 Advanced Strategies and Best Practices. So I'll turn it over to their speaker, Larry, who's going to share what they got with us today.
Thanks, Brianna. Appreciate the invitation and really excited to be here. Let me go ahead and share my screen and we'll get started. So as Brianna mentioned, we're going to be talking about tax-exempt sales today. Management, everything behind what it means to have a tax-exempt sale, requirements, business processes, everything of that nature. So let's go ahead and jump in. First and foremost, this information is Avalara's confidential information. A little bit about me. I've been with Avalara in our Microsoft practice since July of 2019. Worked with hundreds of Microsoft customers, covering every piece of the Microsoft ERP ecosystem. Excited to chat a little bit towards the end of the presentation about how this all works with Business Central. But before we do that, a little bit more about me. I'm married with one awesome first grade 6-year-old out here in Washington State. We've been out here since 2016 when I got out of the military and became a financial advisor with Edward Jones before transitioning to Avalara. So kind of a wide range of professional experience, but been in the Microsoft channel for a little over 6 years at this point. Let's go ahead and dive in. So the agenda for this morning is we're going to cover exempt sales and Nexus. So in effect, what are exempt sales? Nexus is, think, when you hear that term, think requirement. We're going to talk through some use cases based on industry verticals. Then we're going to get into processes around managing those exemption documents, how all of that interfaces with audit risk and audit preparation, and then we'll wrap up with Q&A. All right, exempt sales and Nexus. A lot of you may be familiar with some of these terms, but the age-old sales tax requirement was physical nexus. Where did you have people, places, or things in certain states around the country? Where you had a physical location, whether that be employee, housing inventory, place of business, was where your requirements started and ended. However, in June of 2018, we saw the biggest shift in the sales tax landscape to date, where now physical presence was no longer the only trigger. Now states are allowed to require businesses both with a predominantly B2C, namely taxable channel, as well as B2B, mostly tax exempt channels to, at a minimum, register within their state borders based purely on their sales. That's a huge shift because, again, since the beginning of sales tax regulations, the primary driver was physical presence within a state's boundaries. So since June of 2018, with the Supreme Court ruling in Wayfair versus South Dakota, ruling in favor of South Dakota, we saw every state that had a sales tax regulation on the books adopt what's called economic nexus thresholds. So not only sales within a state's boundaries being a nexus requirement, but specifically how many sales? Looking at a combination typically of revenue within a 12-month period, whether that's calendar year or rolling 12 months, unique order volume within that same time period, or a combination of the two. Now, what does that mean for exempt sales? Every state has their own requirements. Some states, as you can see here, exempt sales are included in the thresholds. Some states only include certain types of exempt sales. Others do not include them at all. You can understand how at scale, this is a lot to manage, because initially, if we go back, a lot of these states were only looking at taxable sales in their initial thresholds. Think mid to late 2018, early 2019, most states were looking at around 200 unique orders and or $250,000 in taxable sales. So you can see here on the left that revenue threshold dropped from 250 down to 100,000 in most places, and went from purely taxable sales to gross receipts. States realized, hey, we're missing out on predominantly B2B sellers, at a minimum to register and start filing $0 returns within our state. So I bring that up because while you may have a good handle on these requirements now, these requirements can shift. So purely staying on top of the changing regulations can be a burden in and of itself, beyond what we talk about, all right, we understand the requirements. How are we going to work those new requirements and ever-changing requirements into our business practices, and in such a fashion that it's not taking an inordinate amount of time or resources just to stay compliant? All right, some considerations for nexus and exempt sales. Kind of what we already talked about, state by state variability, the changing rules. What we already talked about with that kind of transition from states only looking at taxable sales to including kind of exempt and taxable sales in their thresholds. Understanding what your requirements are, how staying on top of them, and then making the business decision of, all right, we believe we've triggered the nexus requirement. What do we want to do? Does that mean we want to go ahead and pursue a registration in that new state or local jurisdiction where required, as well as what's our plan around filing in this new state? All right, so to talk through kind of a use case of these changing regulations, personally, I've done a lot of work with manufacturers in the Midwest, kind of in the Michigan area specifically, where they've been in business for 30 years. They've kept a really good handle on where their physical presence is, typically only staying in Michigan. However, since the Wayfair decision, they realized, shoot, we know we're rock solid on Michigan. Now we have requirements in California, New York, and Florida, or we have no idea. It's that as regulations change, risk can grow. So that can be from new geographies like we've talked about. It could be through outside events triggering a need for new sales channels. A lot of businesses that were successful through COVID launched a new sales channel, typically B2B business, launching retail for the first time. That was a big thing that we saw. So understanding how to continue to grow your business within the confines of these regulations that are constantly shifting and changing is really a lot to manage from a complexity standpoint, ultimately leading to more risk to the business if not addressed with efficient, clear processes. All right, ultimately, the burden of proof is on the business. When we talk about exempt sales, It's proving to the Department of Revenue auditor why you're not collecting tax on a particular sale. And that comes back to exemption certificate management. A customer wants to purchase from your business tax-free, they are required to give to you the corresponding document that's current and valid for the state that they are claiming an exemption for the reason they are claiming the exemption. Are they a nonprofit? Are they a reseller? Are they a manufacturer? Is there an agricultural exemption? It's a lot to keep on top of, but the burden of proof is on you to make sure you're collecting and validating the document that your customer is providing to you. Because otherwise, you would be on the hook in an audit for uncollected tax and accrued interest and penalties. All right, exempt sale reasons. We're going to get into a couple industry verticals that we see commonly in this space. The most common ones that we see are nonprofits, manufacturing, resale specifically, and then these others are still seen frequently, but those are, especially the manufacturing and resale, are the ones that I see the most. So that's kind of where we're going to focus these next few use cases. So nonprofits, pretty self-explanatory. This would be nonprofits like charities, foundations, religious organizations, educational institutions, schools and universities, as well as government entities. So not just federal, state, and local as well. Really what that means is the purchase of product from your business must be for official organizational use. And the way that this kind of whole process works is very similar. You know, they are going to purchase from you in order for them to check out tax-free. You should be collecting the current valid document. In this case, I believe this picture's from South Carolina. That nonprofit should be presenting, hey, here's my South Carolina nonprofit exemption certificate. The complexity here is the burden of proof being on the business. Has South Carolina changed their form number recently for nonprofits? Is that exemption document filled out correctly? Did they sign it? Did they include their tax ID number? All of that information, that burden of proof rests with the business. All right, manufacturing. This is where things kind of get complex. There are sales tax exemptions for materials and equipment used in the manufacturing process. Exempt items are typically raw materials, machinery, equipment, and sometimes utilities used directly in production. So this is really the sticking point. The items must be directly involved in the manufacturing process. The reason this exists is because, like it says on the slide, it lowers production costs, promotes industrial growth, and prevents tax from being passed through multiple supply chain stages. Resale. This is the most common exempt sale use case that we see. It's also where we see the importance of clear and efficient processes within organizations. Meaning, businesses typically will only work with a handful of nonprofits, but if they have a robust B2B sales channel, they may work with hundreds or even thousands of resellers. So each of them could be in a different state, which would require understanding potentially 45 different states, exemption certificate forms, processes, all of that good stuff. This is difficult to manage at scale, and we see the largest scale within the resale transaction space. So this is retailers, wholesalers, and distributors purchasing product from your business for resale. This prevents double taxation and ensures taxes apply to the correct stage, meaning the entity being taxed is the end user. Direct pay. This is a little bit more complex, but also very, very important. This allows qualified businesses to purchase taxable goods and services without paying sales tax at the time of purchase Instead, they're remitting use tax directly to the state. This is typically seen with large businesses, government agencies again, and certain exempt organizations where the business provides a direct pay permit, which is a specific form, instead of paying sales tax to the vendor. We see this a lot with sales to government agencies or government agencies purchasing from businesses. They provide that direct pay permit. So again, all of these, to go back to this slide, fall under the umbrella of exempt sales, but the most common that we see are resale, given the size of kind of the typical exempt sale projects. But these all apply. Each has their own wrinkle on complexity based on type of exemption, as well as based on state and what those state specific requirements are. So it's a lot to manage internally. Drop shipping, to add another wrinkle here of complexity. So for those who are unaware, a typical drop shipping scenario is a manufacturer accepts an order from a retailer, and the manufacturer is the one delivering the goods to the customer on behalf of the retailer in a state where both the manufacturer and the customer have nexus. This is a typical flow chart that we see. Customer places an order, but the manufacturer is applying delivery. The retailer is providing a resale certificate to the manufacturer. There's a lot of wrinkles here based on state, but this is a typical scenario that we see, especially in the e-commerce side through B2B channels. All right. As if it couldn't get complicated enough, exemption certificates expire depending on the state. That could be like Florida, where those documents expire on an annual basis. It could be a 2 to 3 year expiration window. It all varies based on the state, and the states themselves can change the expiring frequency. So, but again, to go back to a few minutes ago, the burden of staying on top of not only do we have the right document, but also when does it expire? Because again, the burden is you cannot allow a business to check out and purchase from you tax-free without a current valid document. So tracking expirations is critical to a compliant process. It's everything we just covered here, so we'll move on. Changes to customer exemption status is a major trigger for expirations. So really this comes down to, are you confident that the information on the document provided to you is still current? Has the buyer had a change in their tax-exempt business status? Have they changed their name, or has their legal entity changed? Has their address changed? That's a huge one. As well as changes in state or local laws. So best practices for managing expiring certificates. Having a process in place to understand expirations is critical. That allows you to take what's historically a reactive process, meaning most businesses will collect exemption documents at new customer onboarding. And that's typically the only time that they really look at them until they get notified that they're being audited several months ahead of the auditor walking in the door, and then it becomes a fire drill. Really successful businesses, as it relates to managing exempt sales, are proactive. They have their arms around expirations by state, by exemption type. So they know no matter if an auditor is coming in or they just do their own regular internal audits, they understand when the documents they're required to manage are expiring and are going out to their customers, especially their repeat buyers, because that's where the risk is. And I'll come back to that in a second. But understanding they need to stay on top of this because they are on the hook for uncollected tax if they allow a customer with an expired document to purchase from them tax-free. So process is critical. And that also means interfacing with the state departments of revenue and understanding if there are changes to form numbers, form types, um, which again, you can quickly see if we're only talking one or two states, that's relatively straightforward to manage. If we're talking about 10 or more, especially when employees at the business are typically wearing multiple hats, we understand most businesses likely don't have a dedicated exemption certificate management um, department set up where this is all people are doing every day. Typically, this is a collateral duty, and the complexity requires very efficient, clear processes. It's a lot to manage at scale. So understanding expirations and understanding requirements and really implementing a proactive process is how successful businesses are able to manage this at scale without having to devote a ton of time and money towards that management. So the ultimate risk for exemption certificate management is everything we've been talking about so far. It is ultimately, if you don't have them, the correct, valid, current document where required, the business is on the hook for uncollected tax, accrued interest, and penalties. From an audit standpoint, we've been told by both businesses that have gone through audits recently, as well as auditors themselves, exemption certificate checks as an auditor is reviewing invoices is low-hanging fruit. It's very easy for them because it's a yes or no question in effect. Prove to me why you weren't collecting tax on these invoices. Show me the exemption certificate. The one you have is expired or you don't have one for this customer. Here's the amount that you owe. At scale, that document management piece, failing to have a good process in place, introduces risk that can have a very detrimental impact on the business. So step 3 here, the auditor finds a $15,000 sale with a missing invalid certificate, resulting in uncollected tax revenue of 8% or $1,200. Depending on your average sales price, we've seen these penalties be in the 6 or 7 figures, where really what we're talking about is managing an electronic document. So the cost of managing the document versus the potential risk and penalty to the business is significant. As you can see here, the uncollected tax fine is calculated as $1,200 times 36 months or $43,000. That likely only took the auditor a few minutes to come to that conclusion. So again, this comes back to process. So we'll touch on this briefly, common audit findings with exemption certificates. And we're going to end this on a positive with what does a clear and efficient process look like that also doesn't take a ton of time for the business to manage. But common audit findings we see is the lack of valid documentation. The date issued does not match the invoice date, but the expirations is critical, as well as businesses trusting their customers that the document that they're getting back is filled out correctly, mainly because you're relying on your own employees who again, we understand are wearing multiple hats, don't always understand what they're looking at when they're doing a validation process because the rules change so much state to state. So missing items on an exemption certificate are signatures, issue dates, but also that business tax ID number is not filled out correctly or it's invalid. So there's a lot of really granular detail and not having a clear process in place or understanding what you're looking at in order to justify to an auditor why your business is not collecting tax on these sales, introduces a layer of risk to the business that, frankly, um, with the clear process and software like we have, is something that we can wipe off the board entirely. So audit triggers, Nexus discovery is a big one. So entering into a new state or realizing that, hey, we realize we needed to, based on, economic nexus, or maybe especially with COVID, we now have remote employees in a particular state where we don't typically have that obligation. Audits can occur where they're going to go back and look at when you trigger nexus. And if you have sales in that state, understanding that the documents need to be on par as well. That's a common audit trigger that we see, frankly, the most. And as we mentioned, when we did the kind of industry use case, 60% of audits target 4 industries: manufacturing, construction, because there's a lot of complexity around that as well when it comes to exemptions, but really wholesalers and distributors. So 2 of the 4 are what we already spoke about. Construction and retail are important as well, but when we talk about manufacturing or wholesalers and distributors, we refer to them internally as highly exempt businesses. And as such, a lot of the risk of the business is centered around the exemption certificate management. So we at Avalara offer a solution within the Microsoft ecosystem that allows for quick, efficient, compliant processes to be created within the ERP. That was a driver for us because we understand, all right, having a system that can help businesses manage these is important, but is it efficient for the frontline user to be jumping from their ERP outside the ERP to a document management system to then jump back to the ERP for their invoicing process, or can we house everything within the ERP? I'm going to jump ahead very briefly here to show kind of what we're talking about. So within Business Central, for example, the same is true for F&O, the same is true for all of our Microsoft integrations. Helping you determine tax includes exemption certificate management, meaning typically we are integrated at the customer card level. So either at new customer onboarding, as you're creating that customer card, you can collect the current document for exemptions, or multiple documents if that customer has requirements in multiple states where your business has nexus, right through the customer card. Meaning the document that you are sending them to fill out has a lot of their information pre-filled, and we're taking the onus off the customer to provide you what they think is correct. We are pulling from the state departments of revenue the correct document for the state and for the exemption reason being claimed by your customer, sending it to them to fill out their tax ID number and sign it. As soon as they hit save, it's immediately applied. Same thing goes for your repeat buyers, your existing customer base. Our tool, integrated with, in this case, Business Central, comes with set expiration windows that you can set, meaning 30 days out from expiration, 45 days out, 60, 90, even out to 120 days. You can request the documents that are set to expire well in advance of the expiration. It's kind of the carrot and stick approach. 120 days out from expiration, you can launch outbound email campaigns directly to that customer, providing them the document that you need renewed, with the understanding, fill in the missing fields so we can continue to allow you to check out tax-free. If we don't get that document back by a certain date, we now have to apply tax to your invoices. We've seen this be very, very effective. This is what I was getting at when I talked about moving the traditional exemption management processes from reactive to proactive. So an auditor can walk in the door at any point, and because you're able to access it through the customer card as well as our platform directly, if you want to do it that way, every document required for that audit. And because we have those expiration windows set up correctly, because it's tied directly into the state requirements, you'll never be out of compliance. So we're doing away with that fire drill of shoot. We know we have an auditor coming in 6 weeks. Do we have everything? Then it becomes auditors coming in 6 weeks. Let's look and pull the CSV file. Yep, we have everything. We're good because we've set those clear internal processes to well before those documents expire. Let's get them renewed. Or if your repeat buyer, that document expires, a clear process around that is important as well from an audit standpoint. We've gotten great feedback from auditors as well as businesses themselves, customers of ours, who have said, yeah, we have very proactive processes to get things well ahead of expirations. But if for whatever reason we miss that window, meaning the customer typically doesn't respond, we are going to go ahead and treat them as a new customer when they come back, whenever that is. Meaning we are not going to allow them to check out tax-free until we get the current valid document required to do so. So that's really what we mean about that holistic process around this, giving you a tool so you're never out of compliance. But if for whatever reason that document expires, having a contingency there. Don't allow them to check out without providing a brand new document. All right. A lot of information here. The focus for today, especially when the Microsoft space was on exemption management, but this is every other area within the realm of sales and use tax and indirect tax compliance where we can help. Happy to provide more information if any of these other terms jumps out as this is something that I've been thinking about, but want to revisit. All of these solutions tie in with what we do in the Microsoft channel. So with that said, it's a ton of information. I've been going on for about 30 minutes or so. I think this is a good time for Q&A. Brianna, do we have any questions?
There's two in the chat. The first one is, will one state accept another state's certificate?
Great question. So it depends. Some states accept multi-jurisdiction exemptions. So it depends. If you fall into one of those multi-jurisdiction states, absolutely. But each state has their own requirements, and some states may not accept those. That really kind of requires us to drill down, but we have all of that logic built into what we call our exemption certificate management platform, whether that's the pro or the premium version. So they can. My short answer is it depends.
Awesome. And the next question is, where do you see most businesses being audited and receiving fines?
Yeah, great question. So most businesses, like I said, one of the first areas that we've been told auditors are looking, kind of the low-hanging fruit, if you will, are exemption certificates. You either have them or you don't, as well as use tax. So typically what we see is auditors will have all of the exemption certificates that the business is managing and cross-reference those against, you know, a window of invoices and kind of do that cross-reference of, oh, I see these invoices to this customer don't have tax applied. These are taxable products or services. Do they have a valid document? So it's one of the first things that they look at, and it's one of the easiest areas for them to assess fines and penalties. Because frankly, most businesses, if they're trying to do this at scale internally, it's too much to manage. So that's kind of why auditors really drill down on those.
So that was all the questions in the chat. Does anyone else have any questions they'd like to ask Larry? Going once, going twice. All right. Well, thank you so much, Larry, for joining us today. We really appreciate it, and we appreciate your support of Doug.
Of course, happy to do it. Thanks for the opportunity.
Yeah, no problem. I'm gonna stop the recording.